Good afternoon, everyone. We'll go with our monthly outlook with first views on global economy. Interest rates are rising globally, but in emerging market, rate movement started early. In most developed market, it started little late. Next slide, please. This had one direct impact on growth. Globally, people are believing this year growth will slow down from 3.5% to about 3%. But most impact will be in advanced economies, which will slow down from 2.7% to 1.5%. Whereas emerging market will continue to see increase in growth led by both China and India. Supply chain pressure has eased off significantly. Logistics is now reasonably at par with pre-COVID level, and this has resulted into taking out some inflation pressure along with rising interest rate. Globally, inflation have started easing off, but it still remains above most central banks' target level. In US, while the target is 2% inflation, the numbers continue to remain in 3% handle. One big problem for central bankers and government is global debt. As a percentage of GDP, global debt is reaching almost 240, 250%. And in absolute term, the global debt continues to exceed $300 billion. The debt burden on developed world is pushing their banks to keep liquidity reasonable and adequate. They have started reducing withdrawal of liquidity by shrinking their balance sheet, but it is happening at a very, very slow pace. Bank of Japan had to intervene twice to keep interest rates under check. As you remember, Japan had 0% interest rate policy for decades. Now, yield even in Japan has moved from below 0.5% to above 0.5%, despite Bank of Japan's intervention. Investors have taken advantage of higher interest rates and put money into bond and cash as an asset class. In equities, flows have been marginal. A lot of money has gone into bond and cash, and will they come into equities when interest rate starts coming down is $1 million question. If we look at US economy, Fed continues to maintain a very strong balancing. On one side, they have raised interest rates at the sharpest pace. On the other side, they haven't withdrawn liquidity as aggressively as it was needed. US yields have now turned positive in real sense. Their inflation is now below the policy rates. Impact of rising interest rates and gradual withdrawal of liquidity is seen in US inflation. Employment as well as US inflation seems to be cooling off. Now, the real question is, will US economy go into recession? If we look at yield curve inversion, where shorter term interest rates are higher than longer term interest rates, are indicating that there is chances of recession in US far, far higher. If we look at US deficit as a percentage of GDP, there is a red signal that recession is probably ahead. If we look at credit card debt and interest rates, US economy is about 7.2 times bigger than India, but their credit card debt at $1 trillion is 40 times higher than Indian credit card debt. If we look at student loans, their student loans is 90 times higher than India's student loans. Clearly, American household is leveraged, and now interest rates in credit card, student loan, etc. remains high, impacting household. Will that cause recession? Who knows? Very recently, there was a comment by Vice President that most Americans are just $400 expenses away from bankruptcy. It shows extent of K-shaped recovery in US and lack of savings in many US households. As interest rate goes up, as repayment of student loan starts, will that slow down consumption and create recession? That's $1 million question. If we look at the number of kids who are getting education at homeschooling, that number keeps on increasing year after year. Does this indicate inability of people to put their kids in school, and hence uneven recovery and eventual recession? That will be $1 million question. Fed's own recession gauge is at an all-time high level, near 40-year high level, which again sounds that recession is around the corner. No wonder Fed has kept liquidity reasonably more than adequate. Their whole intention is to keep interest rates high, which will result into inflation coming down, and keep liquidity more than needed so that growth doesn't falter, servicing of debt continues to happen. Now, many in US believes there will be no rate cut this year. Earlier, market was expecting 2-3 rate cuts by end of 23. Now, most people are expecting rates to remain higher for longer. Even in 2024, rate cut expectations are more in second half than in first half. US interest payments are now exceeding their defense spending and putting pressure on their budget, on their balance sheet. US public debt, as per their budget office, is expected to rise 5 billion every day for next whole decade and eventually cross from present $30 trillion to $50 trillion. The debt to GDP ratio for US now is firmly above 100%. In that background of US economy, Indian economy continues to look good. Majority of headline in July 2023 have been positive on Indian economy. Economic activity is holding up for the June quarter. GST collection is now consistently above 1,50,000 crore. Capacity utilization is around 75%. Corporate leverage is at 15-year low, which means corporates have generated cash to repay debt and now have balance sheet which could take debt for making new investment. Government continues to lead on infrastructure investment, mainly at the center level. States and public enterprises are slowly turning around on capital expenditure. The announcements by private sector for investment is at all-time high level. However, this announcement also has to be converted into execution on ground. India's banking sector is in a very, very healthy scenario. NPS have been provided for. and net NPAs are today less than 1%, return on asset is more than 1%, and capital adequacy is roughly about 17%. Monsoon was a worry, but in the month of July, monsoon recovered pretty well across the country. And today we are seeing that sowing area has improved in relation to 2022, while pulses, jute kind of crops have seen decrease in sowing. Rice, cereals, bajra, and soybean have seen increase in sowing. In rural India, now it looks like as if things are bottoming out, whether it is domestic tractor sales or two-wheeler sales, they seems to have bottomed out. The MSP increase in some of the crop will put money in the pockets of farmers, and we should see after 6 quarters of negative volume growth, rural FMCG companies volume growth turning positive in June 23 quarter. Services exports have provided stability on India's external sector. More than 45% of global GCC are today based out of India, and there is significant pickup in services exports over last couple of years. The worries for Indian economy today is coming from IT companies. In the past, they have been recruiting tens of thousands of people, but for last 3 quarters, the net recruitment is actually negative. Campus offers are getting deferred, lateral hiring has slowed down, and replacement hiring is also coming to a standstill. Will Indian IT company continue to create employment and absorb engineering talent, or artificial intelligence will replace entry-level programmers? That's a $1 million question. Oil prices have moved from about $70 to now about $85. This is mainly driven by production cut in Saudi and other OPEC countries. As crude continues to inch higher, there will be some consequences for Indian economy. In India, core inflation remains sticky. Thanks to higher tomato prices, this month's inflation number will be above RBI's target range of 6%, and potentially next inflation number also could be higher than 6%. This sticky inflation, this higher than target range inflation will mean that RBI has to continue to keep tighter liquidity and higher interest rates. In the Manrega demand, we have suddenly seen increase in the month of June. Now, could it be because rains were delayed this time and monsoon started in July rather than June? Or is there something else? The gross non-performing loans in credit card segment has started rising. It moved up from 2.2% last year to 2.9%. While there has been increase in delinquency, it has not resulted into bad debts as people have started paying after 90 days. Let's hope and pray that Indian consumer continues to remain robust, unlike American consumer. Frankly speaking, we are seeing what happened between Akbar and Birbal. When Raja Akbar told Birbal to make a line bigger without touching it, he simply drew a line below to make line above bigger. The same thing is happening in Indian economy. We have done well. Our macro is looking good. There are some concerns, but they are hopefully manageable. But other countries' macros have deteriorated, and hence we look far bigger and brighter than what we are. In the past, we have missed opportunities. Hopefully, this time, India will convert this penalty into a goal. Coming to equity markets, first quarter FY24 results are in line with or ahead of expectations for many companies. Out of 33 companies which declared result, 12 in terms of PET surprised the market with above expectation results. 12 were in line with expectations, and about 9 were below expectations. If we look at companies, about 1,000 odd companies, about 983 companies to be precise, their profit growth has come reasonably in line with expectations, and profit today is all-time high on a quarterly basis at 2,67,000 crore. A lot of this is driven by banks and financial services, but overall, this is the highest level of quarterly profit for this 983 companies. The corporate profit growth is now growing at 35% over last 3 years compared to GDP growth of about 11%. This is happening because banks have fully provided for NPAs and other parts of the economy are benefiting from formalization. We believe this difference will slow down and corporate profitability growth will move more in tandem with GDP growth in the years to come. Corporate profit to GDP ratio at 4.1% for FY23 is higher over the long-term average of 3.7%. On a valuation basis for large cap, we are trading at marginal premium to long-term average. On mid cap, we are trading again at a marginal premium to long-term average. And for the small cap, we are trading at a slightly higher premium. In the small cap, in the SME cap, valuations are even higher than large cap. This time we are seeing a strange scenario where both small and mid caps are trading at a reasonable premium over large cap. Market cap to GDP ratio is above our historical average of 80% at current 105%. On a one-year rolling beta, India MSCI India index beta has come down, which means we are now perceived as a lower risk country compared to other emerging markets. Capital flows seems to be favoring emerging market Asia, excluding China. A lot of investors are skeptical about China. Most of the investors whom I have met in my US trip right now are talking more negatively about China and more positively about Asia ex-China, including India. In Indian market, FPIs were sellers in Jan and Feb, but post that March, April, May, June, July, they have turned aggressive buyers. Their buying is now reaching about $5 billion a month. This is far higher compared to many other emerging markets. India continues to remain best performing market since COVID lows. More importantly, thanks to all the partners like yourself, we have ensured that FPIs find Indian market entry is easy. Entry is difficult, exit is easy, but entry is difficult. In mid-21 to early 22, when they sold 2,55,000 crore of equity, market came down by 10%. But when they came to buy 2,22,000 crore worth of equity, market went up 20% and at a substantial premium to where they would have exited. What will be the future like? Well, one, markets will get impacted by what happens in US Fed, how long they will keep interest rates higher, what happens to 2024 election, whether oil prices remain in 2-digit or 3-digit, and in September 23, what will be MSCI rebalancing. All these events will continue to have an impact on market. From current 19,500 Nifty, if market has to go higher, it will require yields to soften in US as well as in India. It will require India's premium macro position continuing over peers. And most importantly, election 24 result should come as per market's expectation. In case these events turn out against market's expectation, like global macros deteriorated, global central banks tighten liquidity to control higher inflation, if there is some worries on the corporate earnings, or there is tremendous supply of paper with IPOs and OFS, and election results don't come as per market expectation, then there could be correction in market. At this point of time, like last month, we continued to say, please take profit in a rising market. Please get rid of any non-quality stocks in your portfolio. Be overweight large cap and marginally underweight small and mid cap. Most importantly, keep some cash in your portfolio to take advantage of any potential correction in market in the run-up to election 24. From an equity investment point of view, SIPs across Kotak Equity Fund have continued to add value to investors on a rolling return basis. And more importantly, it gives a reasonably good number over last 10 years, between 15% to 22% across different funds. Even in hybrid and asset allocator fund, alpha remains fairly positive, and it has delivered 16 to 17% compounded return over 10 years on a rolling return basis. On a point-to-point basis, bearing few funds, Kotak equity funds continue to add value to investors. This is also true across some equity and hybrid funds. Even on SIP basis, on a point-to-point, bearing few exceptional periods, most Kotak equity funds have added value to the investors by outperforming benchmark indices. The same is true on hybrid funds as well. We also have concept of smart SIP, where depending upon our allocation in balance advantage fund, we increase allocation in SIP when markets are cheaper and reduce allocation when markets are expensive. Over last 5 years, smart SIP has outperformed SIP returns by 1 or 2 percentage points. Do take advantage of smart SIP for your customers so that they can benefit on the basis of regular investment even higher, in even better. Kotak Flexi Cap Fund is second largest equity fund in the country, and it continues to add value to customers. There was a patch over last 3-4 years where the fund failed to outperform benchmark, but I'm happy to say that from October 21, fund has started outperforming benchmark indices. Kotak Multi-Cap Fund managed by Devinder, since its launch, has done very well and generated alpha of almost 9% over benchmark index in last 1 year and generates 5% alpha since inception. Kotak Equity Opportunities Fund, which is a mix of large and mid cap, has continued to maintain a very attractive track record on performance since inception over last 1, 2, 5, 7, and 10 years. Multi-asset allocator fund of fund is our Harfan Maula fund. It's fill it, shut it, forget it. And over last almost 18 years, it has grown investors' wealth by about 17 times. We are in the process of launching Kotak Multi-Asset Allocation Fund. Our fund of fund has disadvantage of taxation, and hence we are launching this Kotak Multi-Asset Allocation Fund. We say it's load it, latch it, leave it kind of fund. It's opening on 31st August 2023. It will carry forward our legacy on asset allocation, and it will have benefits of taxation, as this fund will be considered equity fund from a taxation point of view. It's like launching a super smartphone over smartphone. The way super smartphone is better than smartphone, we believe thanks to taxation advantage, Kotak Multi-Asset Allocation Fund should continue tradition of multi-asset allocator fund of fund. In multi-asset allocator fund, equity will range between 65 to 80%. Debt will be 10 to 25%. Commodity like gold will be 10 to 25%. And overseas investment, if limit permits, could go from 0 to 15%. Essentially, debt, equity, commodity, and overseas equity, all asset class will be invested based on fund manager's view. If we look at our track record of NFOs over last 4 years, bearing Global Innovation Fund, which remains below par, most of our funds have delivered good return to investors and also have outperformed benchmark indices. Coming to fixed income market, Fitch cut United States of America's long-term rating from AAA to AA+. While this has not created material impact on market at this point of time, we believe over a period of time, the risk premium on US Treasury will increase. Globally, yields have started moving upwards as interest rates are expected to remain higher for longer. Market continues to remain confused about Fed. One set of market believe no more rate hikes. Another set of market is hearing, no, there are more rate hikes. In Indian context, liquidity has increased substantially with foreign exchange reserves crossing $600 billion and 2,000 rupee notes returning back to the market. Inflation has risen higher than estimates. We believe next 2 months number will be above RBI's target of 6% thanks to vegetable prices. OIS curve is also reflecting push to rate cut in 2024 after US Fed starts cutting interest rates. The opportunity continues to remain in 3 to 7 year segment where we believe rate cut and rate hike is evenly balanced. On debt investment, hybrid fund should be looked at. Kotak Debt Hybrid Fund, which has 10 to 25% allocation to equity and 75 to 90% allocation to fixed income, has delivered double-digit return over last 10, 15 years. And it has also outperformed its benchmark indices. For conservative investors, this is one of the best debt-oriented fund. We also have Kotak Equity Savings Fund, which combines equity and debt together to create return for our investors. In this, about net equity is 10 to 50%, fixed income is 10 to 35%, and arbitrage could range between 15 to 80%. Put together, this fund, again with equity kind of taxation, has delivered high single digit, low double digit return to investors. Dynamic bond fund continues to remain our favorite to play interest rate volatility. And again, it has delivered about high single digit return over last 10 years. There are tortoise stroke hare kind of fund on hybrid side where upside is higher than downside participation. Across most of our funds, upside downside ratio remains above 2, and current equity allocation is in neutral territory across most of the funds. On the fixed income side, rupee movement, the buying of Russians, and RBI monetary policy will continue to have an impact. We believe the 10-year yield will remain range bound between 6.75, 6.9 on the lower side and 7.3 on the higher side for some time to come. Gold, we have remained bullish since COVID time. It worked out well in 2020 and 22 and 23. In 21, it didn't work out. Central banks are buying gold after what happened with Russian treasury, Russian holding of US and other countries' treasury. Every central bank is looking to buy gold. Gold prices should also get supported whenever Fed starts cutting rates. We believe Fed will start cutting rates in middle of 2024, and that will again pull gold prices higher. We had talked about how cryptos and NFTs could cause dent on investors' pocket. There was one NFT of Jack Dorsey's first tweet. It was probably trading at $3 million in the past, and now it is available for less than $4. 99.99% reduction has happened in NFT kind of asset class.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.